Welcome to this webinar hosted by the Norwegian Business Association in Singapore, where we will discuss the volatile oil prices and its effect on the industry. I am very pleased that we have such a competent panel with us to discuss a topic where it's challenging to predict the future. Indeed, we are at a historic junction with increased market and economic uncertainties that will impact not only the oil price, but societies at large. Just in the past 6 months, COVID-19, Mohammed bin Salman's and Saudi price war with Russia, and not least Donald Trump's late-night Twitter tweets have immediate and direct impact on the oil price movements. As we are moving further into 2020 and 2021, there will be additional and new forces that will bring the oil price up or down. I am confident that with today's panelists, we will be able to bring some clarity and maybe better understand the different forces impacting the oil price levels into the future. Amrita Sen joins us from London. Amrita is the co-founder and director of research and chief oil analyst at Energy Aspect, an independent energy research consultancy. Amrita is often invited to comment on energy oil price movements on BBC, CNN, and other global media. Leah Parker is also joining us from London. Leah is the editor-in-chief of Upstream, the leading news source for the oil and gas industry, and also keeping an eye on the energy transition. Leah is the former managing editor of Dow Jones Newswire's Wall Street Journal. Eirik Wærnes is joining from my home city, Stavanger. Eirik is Senior Vice President and Chief Economist at Equinor and responsible for macroeconomics, energy, and commodity market analysis. Eirik is also Equinor's Head of Strategy in Mid and Downstream. Morten Haugan is the Managing Director of rigs for Clarkson Platou in Asia and based here in Singapore. Morten brings to the discussion extensive experience from the broking side of the oil and energy business, and he followed the industry supply and demand very closely. I just want to mention to all the participants that you are free to ask any questions throughout this discussion via the chat function. So please do so. So firstly, why are the oil prices so volatile? We are collectively aware, as already mentioned, the recent price war with Saudi and Russia, the impact of COVID on the industry demand and supply, but at a deeper level and more structurally for the long term, what will drive and impact the oil price volatility? Amrita, if I could ask you to elaborate first the way you see it, and followed by comments from Morten, Eirik, and Leah. The floor is yours, Amrita.
Thank you, and thank you for inviting me. It's an absolute pleasure to join such a distinguished panel. I think what you've asked in terms of price volatility is the fundamental challenge that faces so many end consumers and producers today. I think if you take a step back, even before, I would argue, the current recovery in prices that we've seen, the biggest driver initially, like you've mentioned as well, has been the price war or the lack of OPEC plus policy between Saudi Arabia and Russia that happened in March. But the biggest factor driving the volatility is COVID-19. I keep saying this, that in our oil markets, we are never used to swings of more than 2 to 3 million barrels per day on either side. Even when you're talking about the price war between Saudi Arabia and Russia, if you think about it, we were talking about 2.5 million barrels per day of supply surge at max 3. Even if you go back to 2008, 2009 financial crisis, the worst quarter we had, demand fell by about 3.5 million barrels per day year on year. COVID, however, we are dealing with demand losses of anywhere between 20 to 30 million barrels per day at the lows, which was in April. We simply do not know how to account for losses like that. For the oil market, you're going to get distressed given the kind of storage capacities we have. any kind of losses below 5 million barrels per day. And there's not much of a difference between 10, 15, 20, 30 million barrels per day. We simply do not know these kind of numbers. We've never had to deal with them. And that's why we saw the negative pricing in WTI in the US. That's why supplies have had to fall so sharply, because we need to balance this market immediately. Otherwise, we will be running out of storage. And that's the biggest driver of volatility right now. And going forward, what always happens is supply lags demand. So right now, demand, or rather in April, I would say, not right now, demand fell very sharply, supply was lagging, but now supplies are falling quicker, even as demand is recovering. So you're going to see volatility on the other side, much more upside price risk as we head into 2021, because inventories will get depleted. And as inventories get depleted, any small shock, whether it be Libya, whether it be kind of Venezuela or other geopolitical issues, become a bigger problem. And some of the supplies, the risk really is we could be losing them semi-permanently because of the damage we do to reservoirs, because we've never had to shut in production of this scale before. And some of these wells should never be shut in. So we've gone from huge downside volatility to the risk now is in the kind of next 18 to 24 months, gradually. Right now, we have a lot of inventory. We should be very range bound, but fast forward 12 months, that volatility will very much be on the upside.
Thank you so much, Amrita. That's a good elaboration there. Morten, you follow it from a broker perspective. And how do you see it moving forward?
No, I 100% agree with Amrita. She's spot on, I think, in her assessment. I would like to just add a little bit on the structural level of the impact of the volatility. I think also the lack of clear, accurate, real-time actual data and letting people know the actual status on the oil market is something that is a bit contributing to the volatility. It always has, and it always will continue to. I think that's a kind of a structural element that all this time has been behind here. So you have variations on perspectives such as how fast is a recovery in demand coming? What is the effectiveness of production curtailments and cuts? What is the actual true inventory status on the oil? What is the inventory storage capacity? So because of this variation, you also have the structural elements of massive trading where companies will speculate, and which contributes to added volatility as well. So on the structural level, I think that's also something to just bear in mind, that obviously the oil price is always volatile, but like Amrita said, I mean, she pinpointed it right, what's going on at the moment.
Okay, thank you, Morten. And Eric, from Equinor's standpoint, you are crunching a lot of numbers and looking into the current and the future. Is there other elements into the volatility that you are bringing into the equation there?
No, I think Amrita and Morten point. I mean, we're all struggling with variables, and I agree very much to the perspectives here. First of all, what we're concerned with is also the volatility in the sort of in the key market prices is one thing, and that will be high. And of course, in a situation where you have a balance as being so much on a tipping point, if you like, both in terms of storage being very high, the uncertainties about what parts of the supply is actually elastic and can move quickly up and down, and you have the large players now with a lot of spare production capacity in hand. There's a lot of factors that can tip the price up and down relatively quickly. One of the perspectives that we also should bring with us is, of course, that the volatility, as we normally measure it, is very high just because the level of the price is low. So 100% increase in the oil price over a month is something that can happen when the price starts at 17, but it can't happen when the price starts at 50. So the absolute we get these percentage numbers that are very high, but the absolute levels of the change is different than when the price was $60-70. So one of the things that, of course, we're struggling with is also is that there's there's not one oil price. There are several hundred, and differentials are important. The value chain or the supply chain for any given crude through any given refinery, the link to the product market at the end of that refinery and the storage levels at the end of that refinery is enormously important for the netback to any given field and any given oil quality. And we've seen very different movements in the price level for different types of crudes, both the very heavy sour crudes, but also the extreme light crudes have had much larger movements than some of the market crudes like the Brent. So that's also important for us as oil companies to take care of the supply chain and the netback values of any kind of crude. And that is much more difficult in a situation when the market price goes down to $20.
Yeah, thank you, Eric. And Leah, you are following the news and gathering information on the market developments from hour to hour. Is there anything that you see that will add on to volatility, which is not mentioned?
Currently, we've seen OPEC with its recent agreements after the ill-timed price war doing a pretty effective job at restoring some confidence in the market, and we've seen this big rebound in the price. But whether that cohesion holds between the Saudis and the Russians, and whether OPEC will continue to be as disciplined as it has been of late, remains to be seen. And if prices tip back up to a level that's more profitable for OPEC producers, I think they'll be tempted because they have socio-political factors at home beyond just the profitability of their oil that drive decision-making in whether they'll stick to their OPEC quotas.
Okay. So if we look at the oil price historically, it's clearly driven by supply, demand, and socio-economical forces. Will we from now on into the future see an even larger fluctuation in the oil prices as a new normal? According to Equinor forecast in the annual reports I've seen, you estimate the price per barrel to be approximately $77 in 2025. In 2030, you estimate about $80 per barrel. Do you know something about the markets that maybe not many others know, or how do you get to these approximate estimates? And they seem to be relatively firm, Eric. Is that correct?
Well, as all kind of price forecasts, they look extremely precise, right? But that's because you got to put a price out there, right? What I think is fair to say is that when we and any others give an estimate of the oil price at any given point in time, in particular slightly longer out in time, when you assume that markets have sort of balanced out and have reached some kind of equilibrium, that's the only way we can forecast. Forecasting chaos is extremely important. It's extremely difficult. So we forecast a kind of an equilibrium price, and then of course that is done based on an analysis of where we think long-run marginal cost will be. What will be the cost of the marginal barrel? What will be the marginal barrel? Do we still think that demand and supply will meet where we still need oil sands from Canada? Do we still need Brazilian ultra deep water types of crude? What's going to be the impact of the flexible accordion-like supply of shale oil, and what's the cost of that going to be? And then when you look at that, you add in what's the impact of the oil companies now requiring lower prices in terms of break-evens, so that will affect our investments. What's the risk premium going to be? What are the financial costs? And then you get to your best estimates. We are the first to admit that there is an enormous outcome space around that price. And there's also a limited, we can't do that with a very high frequency. in our planning processes, we need long run prices at every type of investment or every investment, and we can't do an update every week. A lot of if you look at the supply side impact of the situation we're in now, almost all the supply side impact that we see now will contribute to a higher oil price into the future than what was the case a year ago, because we're going to drill less, we're going to invest less, we're going to put in extra risk premiums, we're going to have a less efficient supply sector maybe, because we will have fewer suppliers. all those impacts now will drive the price up. And then, of course, the speculation is, what about the demand side? So our best estimate, as it is now, and as we've stated in the annual report, is $80 per barrel real 2030.
Okay, Amrita, would you agree on that the oil price in 2030 will be around $80 US?
I actually couldn't agree more with Eric. In fact, our price forecast is for $84 even earlier. It's like 22, 23. And, you know, I mean, Eric does a very good job on the long term, and he's far more kind of, if you look at the kind of work he's doing across the energy sector, right? So that's even more challenging in terms exactly what he's talking about, kind of filling that gap further down. But even if you look at the medium term in the next 5 years, the problem is, if you believe that US shale never really goes back to the highs, or at least at the very least, the growth in US shale is much more like, let's say, 200,000 to 500,000 barrels per day, mainly driven by oil majors. And I think the one point I do want to stress is that this is even before COVID happened. Last year, or towards the end of last year, people had already started to say, and I remember even earlier this year when I was in Houston, I know we can't think about travel anymore, but you know, if we could, I remember producers, the biggest Permian producers, telling me that in 2021, US shale production was going to be flat, just because the base had become so big and the declines are so much bigger, and capital wasn't coming in anymore because private equity had been burned and there hadn't been returns. So we have to think of that. Like, I think shale has been such a big swing factor, and if that becomes more quote unquote normal, which is like small growth going forward, and to Eric's point, the number of projects we are losing, in any case by 21, we would have had the mega projects come online. We've got a few left in Brazil. Who is going to fill this gap? And now, and this is kind of what I had mentioned earlier, some of the fields and the wells we've shut in, even say in parts of Russia or Oman or Iraq, where there's high water cut levels, these wells may never come back. And I would argue, and I know we haven't come on to OPEC yet, but Iraq is a classic example where Iraqi production in the long term, and I'd love to see where Eric's pegging Iraqi production, people had 5.5 to 8, 9 million barrels per day of production in the medium term. It might be very difficult to get back there, given the kind of lack of investment that we are seeing right now. And I think that's why it's very likely we're going to set up for a price spike. To Eric's point, forecasting is an impossible art, whether it's in that 23 to 25 period or 25 to 30, but we are absolutely setting ourselves up for that.
So here's maybe a difficult question to answer. What kind of impact would it have on that price estimate if it's Trump or Biden that's in charge of US in the next 4 or 5 years?
Well, I can hazard a guess without guessing who's going to win the elections. I mean, it cuts both ways, though, right? We know with Trump, Iran is going to remain an issue, Venezuela is going to remain an issue, but you would think even Iran, like our forecast for next year, actually have some Iranian barrels coming back, simply because, you know, we need the oil in our balances, but B, we can't imagine Iran just kind of continuing in this path for another 4 years. Obviously, with the Democrats in power, there will be more negotiations and you'd at least see waivers being given. But at the same time, the Democrats are very, very clearly pushing hard against their domestic energy, particularly shale, because of high emissions. And shale is extremely carbon emitting, so as to speak. And if the Democrats change their tune, our understanding is Canada probably will as well. And Eric mentioned oil sands, and I do want to say that this is a very different environment. In this ESG environment, there isn't a place for Canadian oil sands in the long term, if you ask me. Much like, you know, Eric will agree in terms of coal, if there's one energy part that kind of continues to decline, it's going to be coal. Canada faces very similar challenges. So in terms of Biden versus Trump, you have the foreign policy side, effectively Iran, Venezuela, versus the domestic side, where I think Biden is not going to be particularly positive. Doesn't mean he's going to shut in shale, but there won't be a lot of investment going into the domestic sector.
Okay. Eric, you were smiling a bit when I asked about Trump and Biden. Are these elements that you put into your forecast political uncertainties?
Yes, but not that direct and not that immediate. And for an energy company that are in here for the long term, most periods for incumbents in global democracies are so short that none of them will be president by 2030 anyway. But of course, I mean, there's a balance here. So it's not the persons, but it's the policies that they bring in, of course, and you have the geopolitical impact, how that will be acted by regime changes, whether that is in the United States or it's in China or it's in Russia or in an EU type of government. That could be affected in one way or the other, and it can go short and long-term impacts can actually be slightly different. Then you have the domestic policies. In the case of the United States, that's both important for the supply side development. To what extent will different governments, different administrations impact the potential growth or lack of growth or decline in the supply side, the shale industry? And then in the case also in the United States, of course, the demand side policies are important. So what do you believe in terms of a proper energy and climate policy in the United States? And that could affect the global oil demand. It doesn't matter what Norway does in terms of the demand policies. And on the balance of all that, it's difficult to, it's difficult to conclude that it goes one way or the other. But I think generally over the long term, we would expect to see the same kind of, supply and demand development, but maybe with a slight difference on the sort of the geopolitical risk premium that you have to add on to the price to any kind of equilibrium level. But that's not only driven by whether it's the Democrats or the Republicans, but it's also in the setting that they're in. It could be Iranian policies, it can be Chinese, it can be Saudi. So what do you believe in terms of general geopolitical climate 5 years from now, which is important to think about?
So if we think about how will the industry and the offshore business in particular be affected in different scenarios for the oil price? Now you're relatively firm in your belief on $80. But McKinsey and others have forecasted the global oil demand will grow on average 0.5% from now till 2033, when demand will reach its peak. Morten, what is Clarkson Plateau's estimates when it comes to foreseeing the impact on the industry, given the many uncertainties and different possible scenarios?
I think, well, let's start with one scenario of the oil price environment, and that's the one we're in right now at the moment, and for the past four or 5 months with the volatility and swings. So let's go through that scenario quickly. I mean, it's obviously pretty devastating for the offshore industry to be in this oil price environment that has been now for the past 4 or 5 months. The impact has been immediate. Oil price has been at such level that it's just not cost effective for oil companies to continue on with the projects that they have plans. So immediately you see cuts across the boards between the E&P companies, averaging about 25% this year, estimated 2020. This in turn means that, of course, the impact on the industry is that there are fewer projects, some cancellations, terminations. There will be renegotiations of contracts, and you'll see the utilization for the rig owners, vessel owners, and so forth. This is the impact of the oil price environment we had to kind of date this year. Equipment orders and services for new projects are just drying out, and we're seeing large-scale layoffs in the service industry offshore, including the oil companies. Like BP announced earlier this week, 10K jobs are going to be cut. So companies are struggling. Financial restructurings is going to be ongoing. We've seen a couple of bankruptcies. We'll see more. So this was an industry before the COVID-19 that was already not in a great place, to put it mildly. It was coming up. But so that's the scenario that we're facing now and have been for the past few months. At Clarkson's, we're thinking oil price of $50+ is kind of a break point where it should imply that the industry will get back to the level we were before COVID-19 and the last year, or before COVID-19 this year. The market, as I alluded to, wasn't great back then for offshore industry, but it was certainly a market in recovery. You had oil companies investing in new projects. There were more tenders going on. Activity pickup, utilization on offshore assets were up in places up in the 80% in select pockets. Pay rates were up. It was a market in recovery, and I think that it had positive elements, a positive outlook before this year kind of hit with the double black swan of the COVID-19, of course, and as well as the oil price war and so forth, oil supply of the OPEC plus select members. So yeah, we think 50 kind of plus is a break point where things will get back to that, which is something I think is very interesting to the industry participants and offshore industry to be aware of. On the sad news, I think there's always a lag time between the oil price being 50 tomorrow morning doesn't mean that everything is back on track. Of course, the oil companies need to see the stability of the oil price for a period of time, typically 6 to 12 months before they decide to increase their spending, which again will then turn the industry for the better.
Sure.
So I think that's what we think as a house in terms of the kind of break point of getting back on track, for lack of a better word. We don't disagree with kind of the 75, 80 benchmarks as well. I think it's certainly going to trend upwards in the coming years.
Okay, I have a question coming in from one delegate that might be relevant as a follow-up, which goes, we have been investing less on exploration since 2015, which should have an impact on future production that should have had an impact by now already, given the lead time of 5 to 7 years for conventional projects. Yet we seem to have a lot of supply at hand. Where is the dissonance? Who will have a shot at that one?
I can try to comment a bit on that. First of all, I guess if you look at where we were in 2015, we still had a large stockpile of projects that were not ready to produce, but that were under investment, and that have started to produce and still are starting to produce. We see that pile of projects that were invested in just before the price crashed in 2014 are still affecting new supply. And it's correct that but then the backlog of projects, the projects that are now coming into the industry as new supply is very, very low. And that's what Amrita mentioned. If you look at the large projects. So we will see the impact on the supply side of reduced exploration. We will see even more of that going forward. And then, of course, that at the global level, to some extent, that has been counteracted by the growth in shale for a period, which doesn't require exploration in the same way. So, but the combination of all these is that the supply side is going to be contributing to a tighter market going forward. And I just want to remind also back to you referred to the McKinsey estimate of 0.5% growth in demand over the next 12, 13 years. That would lead to a demand that is, if it were 100 last year, it would be 106, 107. But what people tend to forget is that we need to replace 5% every year. So if you have a 5% decline rate every year for 13 years, that means that half of global oil supply will have to be replaced, plus the 6 million in extra demand. That's the reality. And of course, the strategy problem for the oil companies is how do you continue to invest in a situation where the oil price is relatively low and where the outlook is that at some point demand is going to start falling, but it's not going to fall as fast as your existing supply. So you have to invest to keep pace with demand even when demand falls, and that's the critical strategic problem.
Okay, I hope that answered the delegate that sent the question. If not, send a follow-up and I'll dig further into it. But thanks for that elaboration, Eric. So if we look at the world, and developing countries are set to account for most of the future long-term oil demand increase. IEA expect around 75% of the net growth in oil demand will be within developing Asian economies in the 5 years ahead. At the same time, the energy transition towards renewables in Asia, and in particular, is gaining very strong momentum. Additionally to that, we have a new generation growing up and having a voice, demanding changes and pollution control. Will the oil price range affect the energy transition in a faster phase towards renewables? Leah, you are closely following the energy transition editorially and with in-depth news reporting. How do you see the trend and transition phase? Will it be further scaled up to levels that maybe surprise us if we all meet again in 5 years, in 2025, and we look back on what happened in 2020? What's your take on this, Leah?
I think it actually really depends on the major structural decisions happening in boardrooms and in the C-suite right now at the majors. And we're seeing evidence that even as the companies are slashing capex on oil and gas projects, that their commitments on renewables and clean technology projects, that they're sticking with those to a large degree. And we're seeing the structural changes happening, with BP, as was mentioned about the deep job cuts, but renewing a commitment and wanting to strengthen their commitment on the renewables front. And we'll hear more about that from BP in September. And Shell, at Upstream, we just broke a story yesterday talking with sources at Shell about their plans for a major restructuring. They've just launched this process, and we'll hear more about that later this year as well. But they're talking about possibly forming a special purpose business unit within Shell aimed at renewables and on strengthening their investment in electricity production and renewables projects. And we've seen Equinor taking a leadership role in wind and solar, and also in CCS projects. So I think even though we've had this crisis, and you would think that renewables will be hit as well, that longer term, as these structural changes happen, where companies are devoting more attention and responding to pressure on the investment side, that will accelerate that, and that'll have a bearing on the oil price. And I know in the BP energy outlook, the annual energy outlook, they talked about this, and they look at different scenarios for oil consumption going forward, and they have massive differences where talking about peak oil in the next few years out to 2040, big differences depending on the scenarios. And so there's a lot of uncertainty, but it does seem like there's been a considered response on the renewables side, and that companies are going from a low base, admittedly, but that they're powering up their plans for renewable investment.
Can I comment on that? A comment from my side on that, is that okay? Can you hear me?
I think, Leo, you're muted.
Yeah, Eric, yeah, we can hear you.
Okay. No, I agree very much to what Leah is saying, and I think it's very clear that the gradual shift, the growth in new types of investments is firmly rooted now in the strategies of all the large oil companies, or large energy companies, I should say, and unfortunately so, because those are the companies that the world depends on in order to have these types of renewable investments, to have the capacity to deliver that type of energy. Because there's, as far as I can see, it's not only the IOCs, but of course it's the national oil companies, and it's the large Chinese and Indian players. They are the ones that will have to build to invest this kind of capital. But I think also that the answer to where the energy transition will be going, first of all, there will be much less money available within the companies, within the governments, to fast track these types of investments. Relatively speaking, renewable investments will probably do much better than oil and gas, but that's because oil and gas is crashing at the moment. But to the global question on energy transition, we're talking about renewables is electricity. How do you get consumers to switch using energy of a different kind sufficiently quickly is a massive challenge. We all, even in developing economies in Asia, we have issues in terms of electricity security of supply. I don't know, but I think I'm relatively spoilt here with my perfect band with 100% renewable electricity in Norway. I have enough capacity in the electricity to work as I do now. That's not the case all over the world. So this is about replacing consumers' demand for energy with something that is not there at the moment. So it's about replacing the use of oil. It's about reducing the use of coal in electricity generation. That first part is probably the easiest one. The difficult one is to electrify transport. It's to electrify the parts of manufacturing that depends on coal, gas, and oil. And it's about building sufficient amounts of electricity grids. It's about backup capacity to renewables, et cetera, et cetera. And that's not only a supply side issue, that's a demand side issue, and it's a policy issue. And I dare to see the politicians in just after the crisis that are more courageous in terms of putting a price on carbon right now than they were before the crisis. And they were not very courageous before the crisis.
And if I can just add one thing to what Eric said, exactly to his point, after this crisis, the focus from the governments is going to be purely on stimulating growth. It's about stimulating jobs, reducing unemployment. And so I think the focus is going to be on industrial activity. You're seeing this in China, and I do think we should really look at the data. We get a lot of the high frequency data now from China, and you're already seeing car usage. So this is gasoline consumption. Their policy on EVs is still, they're still kind of debating it. Car sales are up now year on year for 2 months. But more importantly, traffic data is showing us that weekday traffic is actually higher year on year by 10%. Schools are just reopening, so it could go up even further. Weekend traffic is still down, so people aren't driving. The discretionary driving is still down. The reason I point this out, to Eric's point, these are the countries that are driving oil demand going forward. And COVID can potentially, we get asked all this all the time that, what could be the impact on long-term demand? It's too soon to say. Yes, there'll be probably some people working from home or more, but I can tell you from my own company, people are dying to get back because people do miss the kind of working together environment, however much they like the flexibility. But importantly, public transport, footfall in China, for instance, in the big cities, public transport footfall is down 40%. We forget how efficient public transport is. Even if 10% or 20% of these people decide to drive, you can actually see quite a big change in the demand profiles, at least in the medium term, maybe not longer term, which we kind of need to get our heads wrapped around. Again, like I said, it's too soon, but that's something that is potentially going to have a big impact on the transition as well.
If I can just add to that, I think 100% on, but we certainly don't think this train to renewable transition is stopping because of the oil and gas low price environment. Traditionally it's been the case where the oil price is low, there's less investment into the renewables, but yeah, for the reasons already pretty much mentioned, there is policy targets now in place at the political level, environmental focus and so forth to put pressure on the developments and also the capital markets by ESG focused investments, which for instance, BlackRock is backing out of fossil fuels. They're going into support more on the renewable side. So I think commitments are lining up as well. Europe, for instance, wind is, I think is going to outpace the oil and gas investments in the foreseeable future. In terms of capital spends and investments. So we don't think the train will be stopped, that the trend towards renewable energy will still go ahead as planned. But again, as part of the primary energy mix that we all know that is needed by 2040 and 50 even, oil, I think for that reason, we'll see also the oil price headed in the right direction. Investments have to be made at some point in time soon.
Okay, thank you, Morten. I had to take off my headset, but you can all hear me, I hope. Yep, so we have a poll coming up, so we'll put that up on the screen right now. So while we wait for the results of that one, we move on. And the next question is, in 2020, Asian economies for the first time became larger than the rest of the world combined, based on PPP, or purchasing power parity, increased spending power, and fast-paced growing population in many megacities in Asia. In this process, we also see very focused efforts from government in Asia to develop renewable energy sources. Are we maybe too optimistic when we estimate that Asian economies, to a great extent, will be the driving forces for energy demand or oil demand in the 10 years ahead? Amrita?
I still think Asia is going to remain the key driver for energy demand, simply because the population we're talking about, despite all the focus on renewables, and of course they will, on a percentage basis, they will continue to be the leaders when it comes to investing in renewables, but from an absolute base point of view, they'll still remain low. We still forget that a barrel of gasoline or a gallon of gasoline is still the cheapest way to drive a car when you take the full cost. Yes, renewable costs are coming down, but like Eric said, look, I mean, Norway has a luxury. It's what, 95% hydro, if I'm not wrong. Asia doesn't have that kind of luxury. It's expensive. Yes, I think the key driver for Asia is going to be city pollution. Places like Beijing, places like Delhi, New Delhi in India, that's where they're really pushing towards renewables. But this is much more about coal and power generation, far, far more than actually impacting oil demand, because it's not really transportation. There's some focus on CNG, but still, I mean, even with, say, for instance, in big cities in India, a lot of them have moved to CNG public transport already. Yet, gasoline demand pre-COVID continued to hit record highs month after month. So it's just the population base we're talking about, and as incomes rise, yes, the pace of growth, so that the curve might be shallower than previously expected, say, because there is some more substitution, but we're not looking for an outright decline by any stretch of imagination.
Okay, so we have the result from the poll, and it is 48% believe that it will speed up the energy transition to cleaner energy, 52% slow down the energy transition. So that was almost 50-50. Are you surprised by that result, Eric?
No, not really. I think, first of all, I guess it's an indication that it's pretty difficult to to gauge which way this is going, and the split in the middle of the audience reflects that. It's, I mean, there's also, are we talking about absolute speed or relative speed? Which is, so you can interpret the question in different ways. What I see clearly is, and where I agree with the other speakers, Morten and others, is that the trend towards the energy transition doesn't stop now. It might slow down, but it doesn't stop. And the help it needs from things like available capital, clear policy signals, subsidies, that help will be slower coming now. On the other hand, I mean, as I said, we're crashing investments in oil and gas at the moment, so, or postponing significantly. So the relative development of supply side investments in renewables and other parts of the energy transition, be it CCS or others, might actually be relatively good. So just, I mean, as an example, the COP26 conference has been postponed by a year. That means that there's another year going before a potential tightening of the global climate policies. And that's an important setback as well.
So that comes to the next question we have received. With the increased oil price fluctuation and industry uncertainties, should we expect to see less investments into the traditional oil industry and even less new companies being established in the oil industry? The oil industry is still in growth stage given the projection from IEA, but how will the life cycle of the industry impact institutional investors' investment appetite and decisions? Eric, you touched a little bit upon that, but how important is the institutional investors in the industry right now?
Well, I think as sources of capital, they are and interest, if you like, they're important. It varies probably a bit between different types of companies. I think the general climate from the financial markets towards the industry shifting and the focus on ESG, the pressure that some institutional investors are also facing in terms of addressing long-term sustainability, be that climate change or economic performance or social impact and human rights. All those are coming together here and challenging the energy industry at large. That goes for all kinds of industries. I think the focus will increase, and then all aspects also on renewables growth, on things like rare earth mineral mining, which is necessary in this, oil and gas, coal, local pollution, climate change, all that will. So in that sense, the competition for capital is increasing. On the other hand, the world has a lot of financial capital. Look at the interest rates at the moment. So this goes both ways. Of course, the business model has to address the things like what's the return going to be? Are we going to continue on governments to guarantee the return in some of the things that we're doing? Do we think we will be able? In our case, we have a 78% marginal tax rate on our oil and gas production. What does that do to after-tax returns? So it's the industry is completely shifting from something that has been taxed much higher than other industries to something where we are growing in a business where we still have to ask for subsidies. And the dialogue with investors is going to be increasingly broad, not necessarily challenging, but it's going to be increasingly broad, I think. And who takes care of the grid investments, the necessary infrastructure for us to deliver the upstream electricity production? Who takes care of that?
If I can just add something quickly, we deal with quite a few institutional investors, and particularly in the state side, what's been very interesting for us to see is how requirements, and Eric mentioned this exact word, they're changing, right? So the whole ESG thing, environment, governance, social awareness, anything that's highly polluting, there's very little appetite. And one of the reasons why shale is losing appetite amongst the private equity and other, like the likes of BlackRock, which I think Morten mentioned as well, is precisely because of this, that in some ways the institutional investors, like I know pension funds who are being called by their investors and said, why are you investing in oil and gas? Because I don't want my pension to invest in that anymore, which is very interesting because it goes back to everything else we've been talking about. Without the money coming in, we are going to set ourselves up for an oil price spike, because, you know, one thing we didn't talk about is that if the world economy in April, globally, 90% was under lockdown, right? Give or take. China was coming back, but the rest of the world pretty much was in lockdown, maybe not South America. Even if you say it was 70%, we lost just what, 20 million barrels per day, even if it was 25. That shows you how inelastic oil demand is. So oil demand isn't going away anytime soon, and yet investors want people to invest in renewables rather than the focus being you can still invest in oil and gas, but say, let's make it more sustainable, let's make it greener oil and gas, rather than necessarily say the oil sands of the world. But I think that's where the mismatch is. And that's where I think there is a lot of kind of lost in translation with all these kind of climate activists and talking about lost childhoods and whatever else. It completely defeats the purpose, because we are not going to get rid of oil and gas overnight. It's a pipe dream, because it's still the biggest source in terms of transportation fuel. The focus from institutional investors really should be about making the oil and gas more sustainable and greener, rather than saying move away from oil and gas into renewables.
Thank you, Amrita. I'm cautious of the time. We have set 1 hour, but I'm receiving a lot of questions from participants, which is good. So I need to address a few of them. And this one is, if we are seeing a supply side shock now, realizing a long run increase in price, won't the competitor energy sources such as renewables, which are declining in price, add to the future demand decline of oil?
I think we've covered that, because like I think both Eric and I said that, you know, we basically, yes, we do believe renewables does have an impact in the medium term, but you know, again, non-OECD countries will still need oil and gas. It's really coal, which is where, like Eric mentioned, that's where the kind of the competition arises. But yeah, I don't know if Eric wants to add any more.
Okay, and then we have a good question from our, yeah, go ahead.
No, it's just, there's a point there, of course, that the relative prices of these energy sources will impact the growth rates on demand for both of them. There's an indirect link here, because renewables is electricity, it's not oil. So it's through the transport system. But you got to remember that we now have the opposite impact. We have very low oil and gas prices right now. That leads to a slower replacement ratio, for instance, for cars. Combine that with increased unemployment and much lower economic growth the next years, people will be less prone to replace your equipment, which is today running on oil and gas, to something that in the future will run on electricity. So so the energy transition on the transportation side, there's a risk that will slow down now because of the low oil and gas prices. So what determines people's purchase time of a car is maybe not the expected oil price 5 years down the road.
Leo, could I add something as well?
Yes, please.
Just wanted to mention that I spoke recently with an executive in corporate finance, and they talked about, he talked about the importance of a strategy of splitting off the oil and fossil fuel assets into one arm of the company and another arm for clean energy. And he's been advising companies to do this, and I see that Eni has done that just last week. They announced this split within their business, and you have different risk profiles for different investment pools. And so, you know, some want the higher risk, higher potential return that you can see with oil and gas projects versus the more stable but lower return investments that you might see in renewables projects. So okay. I think that structural change is going to be an important one to watch with all the majors going forward.
I wanted to add just something to that as well. I think we have to remember also that the oil and gas industry is somewhat resilient in terms of finding capital to do projects and expand the right time. Now, I think certainly the backdrop for investors is more challenging at this moment with the fossil fuel investments, ESG and so forth. But by the end of the day, the economics to be interested in investing in this industry hasn't really been there for many years. And I think that's part of what's behind there. In the 90s, I think the financial industry did not support the oil and gas industry as much either. They happened to come back. I think the same can happen now, just a little bit different format, given the ESG preference factors and so forth. But let's not forget that it is a resilient industry, and I think as long as the economics are there, which they are not at the moment, I think we'll see support from the capital markets.
Thank you, Morten. I have another question here coming in, and I need to bring that up because it's pretty good. And that's subsidizing the oil industry like Norway is doing now by changing the tax system could be followed by other large oil producing countries. What effect could this have on the oil price going forward?
Well, first of all, this is not about subsidizing, but this is about moving tax payments in time to ensure that we don't get a crash in the supplier industry, which is the industry that is most dependent on the activity level. So these tax payments will come back later. But of course, to the extent that the combination of tax regulations and the cash flow in the oil industry is such now that we reduce investments more than we should in a long-term equilibrium, and a change to avoid that will lead to less of an activity reduction in the supply industry, and thereby also lead to a speeding up of investments, so that you improve the balance, if you like, in the oil and gas market some years down the road, compared to a situation where we basically just shut in a lot of investments right now and risk a significant tightening of the markets 4 or 5 years down the road. So, and of course, for different countries, that might be it might be an important part of the current fiscal policy measures to avoid the most negative impacts of the massive increase in unemployment. And this is less about the people working in the oil companies than it is about the people working in the manufacturing industry associated with the oil companies, because that's where most people work, in the supply industry. So that's how I think you should look at these types of policy changes that we see.
Yeah, thank you for that, Eric. Okay, I have another question here. At the end of April 2020, the oil price for the first time dived below $0. Do you think the unthinkable can happen again during 2020 and 2021? Could the price drop to zero again with less dramatic market disruption as global pandemics and trade wars, given the fragile state of the world economy?
I can take that one. I don't think so at all. I mean, look, the negative pricing was very much driven by financial flows. It's ETFs. I don't need to go into all the details of it, but essentially we also had a lot of retail investors from China exposed to that price. A lot of people were trying to call, quote unquote, the bottom of the oil price. They invested, but the market was in contango. So when the instrument rolls from the front month to the second month, you have to sell the front month, buy the second month. It gets technical, but it was very much driven by financial flows. And also back then, the underlying fear was we are going to hit tank tops, because none of us knew the scale of the demand decline. Like I said today, we still don't know how much demand fell by, because data is always lagged. That's what drove that absolute madness when it came to prices. And it was like, we need to shut in production of 20-30 million barrels per day straight away to avoid that tank top. So it was that combination that got us there. Now, all those financial instruments, some of those ETFs have closed down. A lot of them have forced people to move away from the front of the curve to further down the curve. So we just don't have that kind of financial exposure at the front. But also on a fundamental level, as we've been talking about, now the curves have flipped. Now it's about supplies falling longer than the demand recovery. Yes, the risk of a second wave is very high, but every government, even us individually, we are taking more measures, being hygienic, the 2-meter distancing and whatever is required. Governments have more ventilators. So irrespective of that, the downturn isn't likely to be anywhere close to what we saw in April.
Okay, we have reached the 1 hour that we have set aside for this. I think we could have continued for many hours ahead. It's a big topic, and it's been a very engaging audience here with a lot of questions. I didn't manage to cover all of them. So I think we have to meet again in 2025, as we talked about, and then look back into 2020 and see what actually happened. There's just one question left there that just came in. I think I won't take that one. Historically, we see a close correlation between the price of oil and gold. Why are the two commodities so closely linked, and will this mostly continue? Because in my mind, there's not really any very clear correlation between the two commodities, but why are the prices so closely linked?
I can hazard a guess, but again, it's to do with financial flows more than anything else. It's to do with the value of the dollar. A lot of people, when people try to diversify their portfolio, they'll often buy oil as an inflation hedge. And then, whenever, and then you've also got gold being bought as a safe haven. So you've often seen oil and gold move. They'll often move in very different directions, by the way. If there's geopolitical risk, for instance, people will buy gold and oil because of different factors, but gold being the safe haven and oil being the exposure to these countries. But they've also moved in different directions in the past. But yeah, there are some issues, and particularly the link to the US dollar and how people diversify their portfolio. We have seen them move in line. But again, to your point, fundamentally, there's no correlation whatsoever.
Okay, then we've come to the end of this webinar, and I thank all the participants and I thank the panelists for an engaging, good discussion. Please follow nbas.org.sg. We have several webinars coming up within the energy and transition elements, so please remain engaged. I thank Equinor for being a sponsor, and I thank Energy Aspect for being here, and Upstream, and Clarkson Plateau. I think, Amrita, you are willing to offer a free consultation. Is that for the participants? Is something you want to say about that?
Yeah, sure. Look, reach out to us if you want to just engage in any of these topics, or more on the downstream. I know we had some questions on fuel oil and so on. Yeah, you can just email me at, that's my first name dot last name. It's amrita.sen@energyaspects.com. And yeah, we're very happy to kind of engage with you and discuss the oil markets, gas, oil products, and kind of show you the reports we are producing.
Thank you. And thank you, everyone, once again. We will meet again. It's a big topic, and we haven't really completed the discussion. There's many more elements to this. Thank you.
Thank you.
Thank you.
Thank you.